Good evening from New York. It is 5:26 p.m. on Monday, March 23rd, 2026. Welcome to the Links.ai market briefing. This analysis is AI generated by Links.ai and is for informational purposes only. It does not constitute financial advice. Markets are now closed after what can only be described as a headline-driven whipsaw session. Let us get right into the numbers.
What a day! The S&P 500 closed at 6,581, up 1.16%. The Nasdaq gained 1.43% to 21,956. The Dow added 1.4% to 46,214. But the standout was the Russell 2000, rallying 2.28% to 2,494, its best session in weeks. The VIX settled at 26.15, still elevated, but down sharply from where it traded before the open. The 10-year Treasury yield sits at 4.33% and the 2-year at 3.61, giving us a 72 basis point positive spread. The regime today was a classic geopolitical relief rally layered on top of a supply shock repricing in energy. WTI crude futures collapsed nearly 12% to close around $87.38. Brent settled near $99. Gold futures, which had been in free fall earlier in the session, down almost 10% at the lows, recovered to close roughly 1.5% lower, around 4,500. This was a session driven by one catalyst, President Trump's early morning Truth Social post announcing a 5-day pause on strikes against Iranian energy infrastructure and claiming productive talks with Tehran.
Let us dig into that, because the timeline this morning was extraordinary. Walk me through the catalyst and the credibility gaps around it.
Around 6:50 a.m. New York time, according to CNBC, there was a sharp and isolated volume in both S&P E-mini futures and WTI crude futures. No identifiable catalyst at that moment. 15 minutes later, at 7:05, Trump posted that the U.S. and Iran had held what he called good and productive conversations, and he was ordering the Defense Department to postpone all military strikes on Iranian power plants and energy infrastructure for 5 days. S&P futures immediately ripped more than 2.5%. WTI dropped nearly 6% within minutes. Here's the credibility gap. Farr's news agency denied any direct or indirect contact with the U.S. Saxo's Neil Wilson put it bluntly, calling it a classic case of the administration walking back Saturday's 48-hour ultimatum to reopen the Strait of Hormuz without losing face. The physical supply picture remains dire. Chevron, ticker CVX CEO Mike Wirth said at CERAWeek that the futures market is trading on, quote, scant information and perception, and that physical supply is far tighter than futures suggest. 20% of world oil flowed through the strait before the war. That capacity is still largely offline. Energy Secretary Chris Wright confirmed the U.S. is releasing 1 to 1.5 million barrels per day from the Strategic Petroleum Reserve, with total global emergency releases potentially reaching 3 million barrels per day. But even Wright acknowledged that prices have not risen high enough yet to destroy demand. So the rally in equities and the sell-off in crude are both trading a hope of de-escalation that may not materialize within 5 days.
And that suspicious pre-announcement volume spike in futures is something the SEC has declined to comment on, which is notable in itself. Let us talk about how this moved across asset classes, because the cross-asset action today was violent.
It was among the sharpest single-session cross-asset repricing episodes in recent years. Here's how the transmission worked. Trump's post signaled potential de-escalation, which immediately crushed the oil risk premium. WTI dropping 12% from $99 to $87 dragged Brent from $113 to $99. That oil plunge reversed the inflation expectations that had been building since the war started on February 28th. Lower near-term inflation expectations allowed the 10-year yield to ease back from 4.38 on Friday to 4.33, a 5 basis point move that doesn't sound large but arrested a multi-day blowout that had taken the 10-year to its highest since last July. The dollar weakened, with sterling recovering to $1.33 and the euro to $1.1582. Now here's where the correlation break matters. Gold, traditionally the safe haven in geopolitical crises, continued selling. Spot gold is now down roughly 25% from its January record of $5,595. According to CNBC, central banks and Gulf states are liquidating gold reserves they accumulated over the past 2 years, shifting from accumulation to capital preservation. Meanwhile, silver has been cut in half since the war began, closing around $64. When gold sells off during a war, it tells you the stress is not about seeking safety anymore. It's about raising cash to cover margin calls and meet real economy obligations. That's a liquidity signal, not a confidence signal.
That gold dynamic is striking. A 25% drawdown during an active military conflict is the opposite of what the textbook says. Let me ask the question every investor needs answered. What does today change for the Fed?
Let me be direct. What was a rate cut narrative 2 months ago has now shifted decisively toward a prolonged hold, with the tail risk being tightening if energy-driven inflation persists. The Fed has held rates steady at 3.5 to 3.75% for 2 consecutive meetings. Their latest median dot projection 1 cut in 2026, but 7 of 19 FOMC participants already expected no cuts this year. The Fed raised its 2026 PCE inflation forecast to 2.7%, well above the 2% target. Now layer on the oil shock. Oil has surged more than 30% since February 28th. Diesel is at $5.29 a gallon, up 40%, and that feeds directly into goods inflation through transportation costs. China just announced a meaningful gas price hike effective tomorrow. Consumer sentiment is already at 55.5, below the 60 threshold that historically signals recessionary behavior. If WTI stays above 90 for the next 4 to 6 weeks, the Fed's 2.7% PCE projection becomes stale and has to be revised higher. At that point, the no-cut camp swells from 7 members to potentially a majority. Today's oil decline bought the Fed some breathing room, but only if it sticks. The base case for rates right now is on hold through at least September. The risk case is that a persistent supply disruption forces the Fed to contemplate tightening in the back half of the year, even as growth weakens.
So, who are the clear winners and losers from today?
Cyclical winners, U.S. energy producers, particularly domestic operators who benefit from elevated crude prices and accelerating Asian demand for American oil and LNG. Interior Secretary Burgum told CNBC that Japan, South Korea, and Taiwan are actively seeking to shift purchases away from the Middle East. Names like EQT, ticker EQT, which gained nearly 5% today, and the broader U.S. natural gas complex benefit directly. Travel and leisure stocks also rallied hard on de-escalation hopes, with cruise lines like Norwegian up over 6% at the open. Structural winners. AI infrastructure remains a multi-year beneficiary. Palantir, ticker PLTR, rose 4.5% after its Maven AI system was designated a Pentagon program of record, locking in multi-year funded procurement. Synopsys, ticker SNPS, gained 4% on Elliott Investment Management building a multi-billion-dollar activist stake, underscoring that semiconductor design tools are a structural choke point in the AI build-out. Midstream energy partnerships like Enterprise Products Partners benefit structurally from the redirection of global energy flows toward U.S. export infrastructure. Cyclical losers. Crude oil futures themselves, obviously, down 12%. Gold and silver miners got hit as precious metals liquidation continued. Healthcare managed care names like Centene, ticker CNC, dropped 5%, and United Health, ticker UNH, fell 3%, reflecting ongoing sector-specific headwinds unrelated to today's geopolitical catalyst, but amplified by the broader volatility regime. Structural losers. Rate-sensitive consumer discretionary and real estate remain under multi-quarter pressure. The 10-year at 4.33 and the 30-year mortgage rate at 6.22% are choking housing activity. Only 12% of consumer cyclical stocks are above their 50-day moving average. European airlines face a structurally significant jet fuel availability problem, with Deutsche Bank noting that 25 to 30% of Europe's jet fuel supply comes from the Gulf region, which is now largely offline. That is not a one-day problem. And to be clear on the travel names, cruise lines and airlines are short-term winners on de-escalation headlines, but if oil rebounds above $100 and the strait remains contested, they become medium-term losers from fuel cost compression.
That is a lot of moving parts. Let me push on the corporate and structural signals. Anything beneath the surface that connects to this macro picture?
Two things worth flagging. First, the suspicious pre-market volume spike. CNBC reported that both equity and oil futures saw sharp, isolated trading activity 15 minutes before Trump's post. Whoever positioned ahead of that announcement made substantial money. The SEC declined to comment. The CME has not responded. If this becomes a pattern, it introduces a new and structurally corrosive risk premium into how markets price political catalysts from this administration. Second, at CERAWeek in Houston, the energy establishment is telling a very different story than the futures market. Chevron's Worth said the disruption will take time to unwind even if the strait reopens, because Gulf Arab producers cut output, Iranian attacks damaged regional infrastructure, and governments are hoarding domestic inventories. Energy Secretary Wright confirmed SPR releases started flowing Friday, but said additional releases beyond the committed 172 million barrels are, quote, highly unlikely. The gap between what futures are pricing and what the physical market is experiencing is, in Worth's words, a problem of scant information. That gap is where the real risk lives.
What is the risk case investors should stress test here?
Base case, talks progress, the 5-day pause extends, and the Strait of Hormuz partially reopens within 4 to 6 weeks. In that scenario, WTI falls back towards $75 to $80 by May, the 10-year yield stabilizes around 4.2%, and the S&P grinds towards 6,800 as the inflation scare recedes. The Fed holds through September and delivers one cut in December. Risk case, Iran denies talks, the 48-hour ultimatum effectively expires by Wednesday evening, and the U.S. strikes Iranian power plants. Oil spikes back above $115 on Brent, WTI above $105. The 10-year yield breaks out above 4.75% as inflation expectations surge. 30-year mortgage rates approach 6.75%. Gold reverses its sell-off and rockets back through 5,000 as the liquidation phase ends and safe haven demand returns. In that scenario, the S&P corrects 10 to 12% from current levels, taking it toward 5,900, with consumer discretionary and rate-sensitive tech bearing the worst of it. The Fed is forced into a hawkish hold through year-end, and the market begins pricing a hike by early 2027. The positioning memo follows from that framework. Highest conviction: U.S. domestic energy producers and midstream infrastructure. Immediately increase exposure over the next 2 to 4 weeks. The structural demand shift from Asia toward American energy is real and durable regardless of whether the war resolves quickly. Secondary conviction: AI infrastructure, specifically semiconductor design and defense AI. Maintain exposure structurally. Palantir's Maven Program of Record designation and NVIDIA's energy grid partnerships announced today at CERAWeek reinforce the multi-year CapEx cycle. Tactical hedge: short-duration treasuries. With the 2-year yielding 3.61% and the Fed on hold, the front end offers carry with minimal duration risk. This is a parking spot for capital while the geopolitical fog clears. Avoid rate-sensitive consumer discretionary and European airlines. Immediately reduce exposure. Only 13% of consumer cyclical stocks are above their 50-day moving average, and the fuel supply risk for European carriers is not priced in.
How does it all fit together?
When you step back, this is really about the market trying to price a binary geopolitical outcome with incomplete information and a single social media post as the primary data source. The equity rally today was real but fragile. It was built on a de-escalation hope that Iran has publicly denied. The oil sell-off, while dramatic, left crude well above pre-war levels and is at odds with what every energy executive at CERAWeek is saying about physical supply tightness. The bond market is caught between growth fears and inflation realities, with the 10-year anchored uncomfortably above 4.3. And the gold liquidation tells us something deeper. Institutional portfolios are under enough stress that even traditional safe havens are being sold for cash. The macro regime has shifted from one where rate cuts were expected to one where the Fed is pinned by an energy-driven inflation shock that may or may not resolve within the next 5 days. That is an extraordinarily narrow window for a market betting on the best outcome.
Give us your 3 takeaways.
1. The risk. Iran has denied talks. If the 5-day pause expires without progress, the market will reprice the entire de-escalation trade violently. Watch Wednesday evening Eastern Time as the critical inflection. 2. The market insight. The gap between futures pricing and physical oil supply is the single most important disconnect in global markets right now. Chevron's worth essentially said the market is mispricing reality. When the largest energy company's CEO says that on the record, listen. 3. Positioning. This is a week to be defensive in structure but opportunistic in energy. Own domestic producers and midstream. Hedge with short-duration treasuries. Avoid anything that needs lower rates or lower oil to work because neither is guaranteed.